Chemical services group Omnia posted a sharp rise in full-year earnings, helped by a good performance in its mining and agriculture businesses. Diluted headline earnings per share increased tenfold to 765 cents for the year to the end of March. Revenue rose 6% to 9.4 billion rand on the back of volume increases in its mining and agriculture businesses and the overall rise in commodity prices.
Omnia market cap 5 billion, price earnings 9.9. They're still not paying a dividend, so we're sitting on a dividend yield of 0. Liston, I want to come to you first. As Laney said in the intro there, revenue up 6% at 9.4. In isolation, the numbers look great, but if we jump back just a little bit, 2009 revenue was 11.1. They're still not firing on, well, certainly not all cylinders. There are a lot of cylinders here not yet kicking in place.
Well, I think it's typical of the industry itself. I mean, there's only so many mines that you can sell your explosives to, and there are only so many farmers you can sell your fertilizer to. So it really is a question of what else it is that's going to give you the growth. And then, as you know, they had that big write-down in 2009 or 2010, write-down last year. And the strength of the rand didn't help that time around either. So I think it's one of those things where they are pretty well more at the mercy of the environment than people might choose to believe.
Well, it's interesting because, as you mentioned, dividend yield still sitting at 0. But Jonathan, one of the reasons perhaps is they are investing in a new nitric acid plant. It's going to cost them 1.5 billion rand. We know it's going to expand the business by a further 30%, and they'll only really start seeing the benefits at the end of the financial year.
Look, I mean, another reason for the dividend is they had a rights issue middle of last year. I mean, you don't have a rights issue and then immediately pay dividends again.
That just makes the bankers rich.
Yeah, well, the shareholders get confused and they don't really know what's going on. So, yeah, they're investing 1.5 billion in a new nitric acid plant. It'll come on stream beginning of next year. So in the next 12 months worth of earnings, we're going to see very little from that nitric acid plant, but then certainly the following year it should start kicking in and adding to the bottom line.
And it is, as Liston alluded to, a very cyclical business, and in many cases not a heck lot they can control. The one thing that I was pulling out particularly in terms of from their presentation, looking at meat consumption, food consumption going forward, I mean, maybe not this year, maybe not even the next couple of years, but down the line there's going to be huge demand for the fertilizers, etc., which is part of what they're doing, which is part of what their new complex is about. Yeah,
well, I mean, that's the thing. I mean, the world's population is increasing. There are more and more people eating meat. When you eat meat, you need more corn, more maize, because you feed that to the animals, and as a result, you need more fertilizer to increase the yields from your agriculture.
And I think you hit the nail on the head though, Liston, because some of the investors out there that we speak to about Omnia, they say it's a great company, but it's very cyclical. It is extremely volatile, and this is why many fear to trade where Omnia goes.
Yeah, well, I think when you've got volatility, you want to have a very sound balance sheet, so you can carry on paying those divvies, because that does keep quite a few people in the game. So I think, the problem is the no divvy and some volatility, and now a new development, which is quite sizable. Honestly, their profits were about 400 and odd million this time. So to be spending 1.5 billion of that,
it's little over 3 years worth of profit.
That's 3 years worth of profit going, yeah.
And also in their weak space, I mean, the one area which really performed, mining operating profit was up 47%, margins up at 14.9. Mining in itself relatively small at 19% of revenue, but really providing that income going through. That section seems to be going well, as you said. How many more explosives can they sell? So that's probably capped. They've really got to now get the others to start working, particularly that chemicals.
Yeah, but I also take a bit of heart from the fact that they say something like 37% of their revenues were from outside South Africa. So that does mean there's some benefit there, but they don't mention quite the profitability related to that 37%. I suspect it's a little bit less than the local.
Yeah. With regards to electricity costs, we know the new plant actually is going to be supplying 50% of the required electricity, which means they can perhaps leapfrog some of the increases that we've been seeing from Eskom as well. What is your view about the new plant? Do you think that it is going to make good on all the optimistic views that the company has come out with?
Well, I mean, they said they're spending 1.4 billion and they hope to add another 280 million of pre-tax profit from the plant, which, if you took it in an after-tax return, it's kind of a 14% return on capital, which is, it's all right. I mean, obviously the electricity generation is a nice benefit, but it's not, certainly not a material game changer.
But the word you used there is all right. I mean,
Yeah.
14% is nice, but it's not exactly shooting the lights out.
No, it's not shooting
It's
the
a
lights
big
out.
bet by Omnia in a sense. I mean, they and they're probably saying the 14% and in truth holding thumbs, and it might kick in at 16 or 18, but probably not.
Well, I mean, the one positive thing is they did say that's on a 60% utilization, which they think they'll be using at 60, even slightly higher, right from the day go.
Okay, so Liston, hot or not for you, Omnia? And we know, I mean, we perhaps look at it relative to AECI in a sense.
I'm going to say not.
Not hot. Tell us why.
Well, as I said, I don't think the dividend yield is attractive, and the volatility of earnings is not attractive, and they're going in for something new, which we often find experiences difficulty in the first year or two, and often puts a bit of cash flow strain on the company. So, for me, not hot.
And with regards to if we do see all the troubles then being sorted out and the plant making good, as I mentioned, on some of the rhetoric that we've been talking about, would it be a company that you'd look at? Would you say just too volatile for you?
No, I'll always look at Omnia. I think it has a very special place. But just on a 10% yield, I can probably get some others. A 10% PE, I can probably get others on a 10% PE, a 10 times PE. And this doesn't sound as though the big kicker is going to come in the next year. It's probably 3 years away.
And those others in 10 PEs probably give you a dividend.
They do.
Jonathan, hot or not?
Well, I mean, I ran the numbers this morning, and actually, we were around a ranking table, and it sits in the top quartile, so it is actually quite hot for me. I do, obviously, the next 12 months, I think earnings per share might actually be down because you've got a higher number of weighted average shares in the next 12 months. But post that, you should see an earnings kicker from the nitric acid plant.
Fantastic. Okay, Simon.
I am going to go with Liston. I think I'm going to go exactly what he said. If they were paying me 2 or 3% a year to hold the share, I think I could take all the troubles. But if they're paying me 0 to hold it, then I look at their $1.5 billion at 14%, and I look at their debt. A lot of it short term. No, I'm going to say not hot. I think it's a stock that I want to come back to again in 6 months and 12 months with numbers out, but not just yet.
Okay, so Jonathan, would you be accumulating then at these levels?
We haven't bought any, but we're certainly looking at it.
Fantastic. Okay, well, let's shift gears now. Mine holding company Assore and Shanduka Resources will sell an 11.8% stake for 2.7 billion rand as part of larger plans, enabling Assore to meet domestic ownership rules. Shanduka will sell the stake in Assore, owner of half of manganese producer Assmang, for 163 rand a share, a 27% discount to yesterday's closing price of around 222 rand and 91 cents.
We've got a market cap just over 30 billion, a price earnings 12.2, a dividend yield of 2. Jonathan, let's come to you first. The one thing that strikes me about these guys is they have a little printing press in the back which just seems to generate cash. It generated $1 billion in the first 6 months. They're sitting on almost 2 billion cash. They've got some commitments out there, but in just a cash generator and, in truth, a cash hoarder.
Yeah, well, I mean, you would expect from a company that's generating that amount of cash a higher dividend yield. I think we're probably going to see some of that now when they report in June. We'll probably see a higher dividend. All the iron ore companies are printing cash. I mean, you look at Kumba, it's a similar situation. I don't really like the space from the fact that I'm very nervous of long-term iron ore prices, and we've seen a crack in the manganese price recently.
Yeah, and that's the point. I mean, it's iron ore, and I suppose, is it, I don't want to say perhaps bubble, but it almost got ahead of itself and unsustainable over the sort of the next couple of years.
Well, I mean, we look at cost curves to see where, if you had to build a new iron ore mine today, and generate a good return, what would the iron ore price be? And it's significantly lower than where it is right now. So, when we're looking at models and longer term, we're very negative on the iron ore price, and as a result, iron ore companies.
I think it's reflected in what we're seeing in the Assore's share price. We've seen significant pressure coming through. Listen, do you think the investor community is just not liking this deal?
No, don't say that at all. I mean, it's basically just changing the name on the share certificate. But to get it out and to do it ahead of a closed period, you just feel that it was done at a bit of pace, but it had to be done at some kind of discount, I would believe. So, the actual deal, I don't think should affect people's pricing methodology elsewhere. There they now start to look, as we do, at the fundamentals. And I take a slightly different view on the iron ore price. It certainly hasn't done too much or had too much damage in the recent past. And part of that is largely because a lot of iron ore prices are fixed for a year, and we're in the negotiation patch, as we sit here now. And it will be interesting. I've seen some negotiations, particularly BHP Billiton, with the Chinese, and it looks as though they're going for an increase. So it doesn't look as though we need to worry too much about that.
Is iron ore very much a China story, or is it much broader than that?
Its big story indeed is China because of the steel.
Mm-hmm.
And
the construction and development they're doing in China.
Exactly. And what I've come back to is it would be quite interesting to see what would happen if the rest of the world was also moving ahead at a time like that. So, but you can't have growth without steel. It's as simple as that. So yes, it is potentially dangerous if China were to slow down, well below the 8 kind of level that we're talking about. I might become a little more concerned, but right now I'm not that concerned.
What about quarterly contracts and pricing methodologies when it comes to what we see in the spot markets and what we see in the South African market?
Well, I mean, there's been a big move after BHP and China had a big fallout over pricing to price more of the spot market. So that's certainly where it's going, and I certainly think it's better, it's more transparent.
Sorry. Free float 25%. Now that's something I look at. But in the smaller stocks, Liston will come to you. In the smaller stocks, a couple 100 million market cap, that small free float is absolutely an issue. In a stock of a 30 billion market cap, can we look at that and say, 25% of free float is actually suffice because of the size of the company?
Yeah, I think it is a problem. I mean, people would be naturally hesitant. I mean, even if it is a 30 billion market cap, you're only talking about 7.5 billion, and then how many people are going to move and not move? Definitely a liquidity problem for many institutional investors.
Hot or not, Liston?
Not.
Not hot. Okay. Straightforward answer.
Not.
Okay. Simon?
No, straightforward answer, not. I mean, let's see their numbers and maybe they've got a better dividend, but I'd rather go Kumba.
Okay, Kumba, would that be your play then if you wanted exposure?
I believe Kumba is going to come out with up earnings and an up divvy, and it's on a very nice dividend yield right now.
So safer bet, and for you, Jonathan, as well?
Yeah, I own neither of them, and I wouldn't buy either of them now, but I'd take Kumba over.